Welcome back to Vetted VA Live. I'm Josh Lewis. I'm your host. For the three of you who like to tune in here every week and check it out, probably aware that we took a little time off for the holiday. We're back here trying to set the tone for what's to come in 2023. For those of you getting ready to buy who may be out in the market, we're back here every week with 2 to 3 of the experts from the Vetted VA forums on Facebook and answering questions that are important to you. So what we're going to do tonight is we're going to go through and give a little bit of a market update. Market has absolutely shifted since the spring and early part of the summer. We're going to talk about what we're seeing in our individual markets. We're going to talk about some nationwide numbers. We had a few indexes release their September figures today. We're going to go through that, and we're going to transition to what it means to you as a buyer and how you may be able to get some seller concessions and the best ways to allocate those seller concessions to keep your cash to a minimum and your payment as low as possible. So with that, I think we've had all three of you, definitely Sarah and Jason, on before, but let's just quickly go around the horn, introduce yourselves, and let everyone know where you're at. So we've got Sara Acevedo-Schwocher, and she is in Chicago with Century Residential. Are you actually in the Chicago, the city, or are you in the suburbs there, Sarah?
I'm actually in the suburbs, just a few miles away from the city. So I do business in the city proper. I go as far north as the Wisconsin border and as far south as the Indiana border. So cover a lot of ground. I go where my clients need me to go. Since the majority of my clients are veterans or active duty, I go where they need me. I wish I was one of those agents that just restricts themselves to a 1 mile radius, but that's not the case.
I got it. Jason Turner is with Navigator Mortgage Brokers in Bowie, Maryland. Is that where you're located, Jason?
Yes, sir. Yes, sir. That's right. I service all of Maryland, and I also do Washington, D.C. here and there. So that's my main footprint.
Perfect. So we got DC and Maryland, and then Ben, you are in Tennessee, Johnson City, Tennessee, with American Mortgage Network. What states do you cover? You were telling us that you just added a few additional recently.
Yeah, I've always just focused on Tennessee, but in moving to this market recently, this is near Virginia, and that's technically part of our market. So now I added the Virginia license to be able to help clients that are, over the line in Virginia. So Tennessee, all of it, East, Middle, West, and Virginia.
Perfect. Well, let's jump in and talk a little bit about what each of you guys are seeing in your market. One of the things that's really important, the media likes to talk about real estate like there is one real estate market across the country, and it could not be further from the truth. And we've got a pretty diverse group here in terms of Midwest with Sarah. We got East Coast. We've got Tennessee, a little bit of the South there, and I'm out here in California. So the numbers that we saw today, September housing figures, the Case-Shiller Index, which is one of the best indexes, is considered the kind of the gold standard for what's happening in big markets. But again, remember, this is a nationwide index. And the reason why it's considered one of the best is it's a paired sales index. They're looking at the same homes selling over time and then making adjustments to that. And what we saw, the big headline that everyone's talking about is prices were down 1% month over month. But probably the bigger headline for those of you in the market right now is that the year over year figure was still up 10% over this time of last year. So the other index that we got was the FHFA index, and this only includes government loans. So it doesn't pick up cash buyers and jumbo loans. So you kind of get same kind of data, but a little bit different feel on that. That was plus 0.1% month over month. So essentially flat, but also up 11% year over year. Sarah, how does that compare with what you're seeing in some of those markets of Illinois, Wisconsin, Indiana, most of the Midwest?
Yeah, I find that to be interesting. We aren't seeing a whole lot of homes that are selling above asking price anymore. We're definitely not seeing prices going up. They are steadily going down, not by a whole lot and not drastic numbers. So we do still see homes that are selling fairly quickly, and then we're seeing homes maybe in higher price ranges that might be taking a little longer to sell than sellers had hoped. So with winter creeping in, we're seeing some shifts there for sure.
From your perspective as a realtor, the homes that are selling quickly and that may be getting multiple offers, what do those homes look like, and why is the rest of the market not seeing that versus still we're seeing small segments of the market have good activity and volume like that?
So I think that it depends on the price range. If we're looking at homes maybe anything from say 150 or 200 to about 400,000. Those are selling fairly quickly, still with multiple offers. You've got a greater population, a greater demographic of people that qualify for that price range. And they're still out, they're still out looking, and the competition is still pretty stiff with that. Starting at right around the 400 price point, homes are definitely sitting a little longer. They're taking a little longer to sell, even when they're priced right. So patience to the sellers, just a little bit of patience. We're back to a normal market. I think that we were all spoiled over the last couple of years, but this is what's normal.
No, it's funny. Most agents have not seen a market like this where you have to actually try and sell a home. And we've had little dips over the last 5, 6, 7 years where things kind of slowed down. But for the most part, it's been agents the last 2 years post-pandemic most times didn't have time to print flyers for their listings, didn't have time to do an open house. It was put it in the MLS and then field offers for the first part of the week. So you're definitely seeing the expertise of the people who have been around and are able to do that in terms of advising their clients. What advice are you giving sellers when they're pricing their homes right now when they list with you?
You got to price it right. Pricing a home it's an art. So you don't just look at homes that have sold previously. Well, that's a big part of the equation. You also need to look at your competition and what are other buyers seeing. And unlike a market analysis where we look simply in the immediate neighborhood, when you're looking at competition, you want to look outside of your neighborhood. Buyers will look in different areas, different towns, even, neighboring cities. I know that in some parts of the country, towns might be far away from each other. You might have some open land and, then you come across another town. But in my area, we're a little more densely populated. And so right across the street, you might have a whole other town. And so it's much easier for your typical buyer to jump from one town to the next. So definitely price right. I would have to say that when it comes to looking at homes, it can be tricky with the pricing. You don't want to price too high or else your home will sit. And you certainly don't want to price too low, although pricing just under the market could get you the best bang for your buck.
Perfect. So that gives us a good view from the Midwest. Jason, when we transition over to your market there in Maryland and DC, what are the most common price points? Obviously, all of these markets, Chicago, DC, have really high-end homes. But for most of us, we're not dealing on the super high-end, especially our veteran borrowers. We do some big VA loans out here in Southern California, but mostly the price points are a little bit more towards the median. What are you seeing in your marketplace for most of your clients, Jason?
I mean, I've seen... Honestly, I've seen it at all price points. I don't do many jumbo loans, even though we have high loan limits here because I work with a lot of veterans, right? But the biggest change that I've seen is the concessions. The concessions, I was talking to one of my agents today. They got a 6% seller credit on their contract accepted today. And I was like, wow, I haven't heard that, in a long time. So to hear that was very surprising, but that's kind of where we're trending right now. It's much more balanced market, even across the board. I mean, that was a $500,000 house, which, is not cheap. Let's call it what it is, but it's not $1 million. But as far as the evening of the market, that's definitely what I'm seeing in this area.
I want to make sure that we circle back and go a little deeper on that discussion. Once we go through concessions and what they are, I want to get Sarah's feedback on that. What are we going to use 6% for? Is that the best way to get a seller concession versus a price concession, some of the other things? And for us, 3 of us here are loan officers. We get the contracts come to us. They're negotiated without much of our input. Sometimes a realtor will ask and say, how much of a concession do we need to get them in with no money? Or, hey, we want to do a buy down. How much do we need to cover that? But let's definitely circle back and have that discussion. Ben, for yourself in the Tennessee and Virginia markets, how does that compare?
I would say I'm not overly familiar with Jason's market, but if you look at the state of Tennessee, it's a lot similar to where Sarah's at in Illinois. Illinois north to south, totally different markets everywhere you go. Tennessee, east to west, west to east, whatever, where you have anchored giant cities, well, metropolis areas, whatever you want to call them, and then in between there, dramatic differences. So what I've seen as far as pricing goes, what I have seen though, as far as the process and attitude, same thing that Jason's talking about. I have just my most recent client that I'm helping is active duty who's PCSing to Fort Campbell, Kentucky, and people who, because Tennessee doesn't have a income tax, state income tax, Fort Campbell's right on the line, and so Clarksville, Tennessee is where everyone lives who gets stationed there because you get to keep more of your money. But I believe the sales price was $298, and they went in asking for $8,000 in seller paid closing costs, and I'm just really used to holding my breath because over the last probably 3 years, really, it's like I really hope that happens, but you're used to something, and it was like accepted, done, no questions. And I was like, okay, this is a different market, and the sellers, the values of homes aren't really changing. It's what people are paying for them that's changing, or what people are willing to, if you're selling a home. I recently sold my home. I did that. I gave them some seller concessions for closing costs. Sometimes people do that in repairs, but I wouldn't call it a buyer's market, but it's definitely more cooperative between the seller and the buyer now.
Well, it feels a lot like that just because we were so conditioned over the last few years. I mean, we did an episode in the spring. How do we get a VA offer accepted? Because agents were just not presenting VA offers. So they're like, no, we need a big down payment. And what we're going to go into here in a moment is seller concessions. What will a seller give you to buy their home? Well, even as recently as the spring, but definitely 21, most of 2020, the question was, what are you willing to give up to be able to be the winning bidder? You're giving up your timelines, your contingencies, paying over list price. So when we get back to a point where you get a 1 or a 2% seller concession, or you can get a $5,000 or a $10,000 price reduction, it feels like a really strong buyer's market. I've got a deal here in California for a veteran relocating from Michigan. They were qualified well up over $1 million just with where the market is. They weren't sure where it was going. They put a property under contract for $840 about 3 months ago. And the agent tells me, hey, I don't know that we're going to be able to get that thing to appraise. Very nice house, but it's infill development. It's technically a condo, even though it's detached on a single lot, but there's like 12 of them. There's no other condos around. Sure enough, our VA appraiser goes out and brings it in for $715,000, $125,000 low. And everyone in the transaction is like, that's nuts. Like that is crazy. We were convinced it probably wasn't going to appraise at 840. So we didn't do an ROV. We didn't go back to the VA and ask them to give us a better value, even though we thought it was there, because it was so far apart. Seller puts it back on the market. They put it in escrow. It doesn't appraise for that buyer. That buyer walks, even if there was a conventional buyer. So we went back at that point, had some conversations. We did the reconsideration of value, and they brought it in at 790. So we originally had it under contract at 840. Seller 3 months ago wasn't willing to do anything. Now, this is a very nice property, but it's a very motivated seller. They have their up leg. They know the house they're buying and where they want to go. We ended up in contract at 788 with a 790 appraisal and a $10,000 seller concession. That's just over the last 3 months. Now, again, it's a very motivated seller for a reason that they have a property that they want to make sure that they don't lose and get to. You can also have a motivated seller because they know they have a property that's not that great or has some issues, not the greatest neighborhood. So lots of changing here. For us in California, the market is really different. It's such a big state that we just have lots of micro markets throughout the state. And some of them are faring worse than others. But for the most part, prices have held in. We're seeing concessions. We're seeing normal contingencies. We're seeing buyers able to get repairs. We had a situation where, for a year or two, sellers wouldn't do repairs on a property knowing that their home had issues. That stuff's not really a problem at all right now. One question that I had for all of you guys, something that we're seeing here, not necessarily geographically, but when you have that beautiful turnkey home that looks like it could be on HGTV, buyers are reacting to that. And we are still seeing multiple bidding situations on those. It's not 10, 12, 15, but you'll have 2 or 3 buyers, and those are going at or just below or just above list price. Are you guys seeing that in your markets, that the beautiful turnkey homes are still getting quite a premium and you're not going to be getting the discounts that we're talking about?
Yeah, I am. I mean, I still have clients who are writing above list in competitive offer situations. It just depends on the house, like you said. Like, if it's a awesome house with a 3-car garage, and the guy wants to use it to do whatever he wants, like wood shop work or whatever, because this house is unique and it's very special to him. Then yeah, like I've seen that very recently, where they wrote over the contract price and ended up getting it, which was fantastic. On the flip side of that, my wife's a realtor, and she actually showed 8 houses yesterday, and 4 of them had price reductions. 4 out of the 8, so over half in the market that you saw yesterday had price reductions. So it really does depend on the house from what I've seen.
Absolutely.
And I've seen one of the holdovers from the crazy period that we just went through, the frenzy, is, and Sarah can probably attest to this more than I can, but a lot of sellers were unwilling to make repairs or to make their house list ready. And so it was extremely common. You go look at 8 houses need something. Nobody's going to repair it. You got a negotiator to go through it. Now you talk about a turnkey home. Well, you go look at 8 houses in my market. You might have 2 that are turnkey out of the 8. So it definitely moves quicker, has multiple offers. You might even get somebody paying a little bit over. But for the rest of them that are need something, or that's going to be negotiated, those are, I mean, honestly, as long as it's not something major, that's where you're going to find your value. That's where you're going to find your best deal as a buyer.
Well, I like to tell people, over the last couple of years when prices were shooting up, we'd get people call, hey, I want to go get a fixer. I would say, this is absolutely not the market for a fixer, because you're going to get a 10% discount on a property that needs 20% of market value work to get it to that condition. Are you guys seeing a little bit of a shift back where the fixer is something that's not quite as nice, it's not that HGTV ready home, is getting enough of a discount where it makes sense?
I sure hope so, because I have a couple of those coming up now.
Yeah, it's an interesting market.
I guess you have to coach the sellers in the reality of what they're about to meet when a buyer comes in, because that is definitely, I think it's there. I think we're on that crest to where you're going to be able to do what you're talking about, where if it needs 20%, you're going to be able to get it, at least 20% discounted at least. But not, I think we're almost there, not quite yet.
Well, it was an adjustment period, because I mean, when things first started leveling off, it happened relatively quickly, and sellers were just had a hard time adjusting. They were used to, the beautiful home in the neighborhood would sell, and the ugly one would come on the market and they'd say, I want more than that. My house is nice too. So it definitely is an interesting market. As a buyer, it's a good time. You've got options in terms of the type of inventory and how you're going to pursue it. And we're going to get into that. So Jason, why don't we start with
one more thing to that?
Sure.
I just was thinking about what you were saying in our markets here, and I've seen it in all the different markets in Tennessee. It's not necessarily beautiful versus ugly, repairs versus no repairs. There are so many new developments being built in Tennessee that the newer homes are actually the ones, even if they do 10 years old, that need something. The newer homes are the ones where they're selling faster. They're having more than multiple offers. When they get a little bit older, in the style or design might be from the Home Alone house, with the green tile or whatever. Those are the ones that even if everything's good, it just people. That's what I'm seeing here. They have too many new homes to compare it to, I think.
And that's interesting. Sarah, Jason, how are your markets in terms of new construction? For us in Southern California, we're pretty built out. And a little of the Inland Empire further out in the desert, there's a chunk of new construction, but it is not a big piece of our market. And that can be a big difference, because when you have a builder who's built a home, no intention of holding that home, they have to sell. So they're going to adjust to the market a lot more than an individual seller who can just say, wow, I don't like that price, I'll just stay here a little bit longer. Do you guys have much new construction activity in your areas?
Yeah, I do. I have a fair bit, and they're really kind of controlling the market because they have what everybody wants. Honestly, they're giving concessions for the closing costs, like in a large amount. So buyers aren't really paying closing costs, and they're also offering aggressive interest rates compared to a lot of other lenders. So I mean, builders are kind of in control of the housing market from my perspective. When I mean, they're really tough for me to compete with on a lending basis because of what they have going on and the control that they have. But I mean, we just deal with it as best we can here. But the builders that are building here are in a good position.
How about your market, Sarah?
So in my area, we don't have a whole lot of new construction developments. You would have to go probably about an hour out from the city in order to find new construction homes. We're an established area. The homes in the city proper have been built anywhere from the 1880s to 1930s and, some more as the years went on. But if you go a little further out, even beyond suburban and semi-rural areas, you will find the new construction homes. I don't deal a whole lot with new construction, so I won't speak to that. But as far as homes that are in turnkey, move-in condition, yes, those are definitely selling a lot quicker. We may see those going for over asking price with multiple offers still. And then as far as homes that may need some work still, pricing is everything. That's everything. And obviously how an agent markets the home is going to have an impact.
So we've talked a lot about concessions and that we're seeing more seller concessions than price cuts or big, huge reductions relative to recent sales. Ben, you kind of want to walk us through just in simple terms for someone watching at home tonight or seeing a replay of this and they want to know a seller concession. What is that? What does it mean if you're asking a seller for concessions?
So that term tends to be used generically a lot of times because there are actually two different things. You have seller concessions and you have seller paid closing costs. And the reason that gets generically done is because in the majority of loans that are done are conventional, right? So there's pretty specified limits. So people say concessions. On VA loans, there's two categories to allow for more if a veteran buyer needs it. Concessions are limited to 4% of the sales price, but there's no limit on the seller paid closing costs. So it's kind of a thing. But what are they? It's where the seller is going to allocate, I guess, in a better way. If they're going to make $50,000 on the house, they're saying, hey, we negotiated that you're going to get 10 grand towards your costs, whatever it costs the buyer. And so there's not actual money changing hands. That would be illegal. It's done on your closing disclosure, on your loan estimate. You'll see it, but it's definitely on the closing disclosure where the seller, instead of them getting a $50,000 check, with their loan proceeds, they're going to get 40, and then 10 of what would have went to them gets applied towards your cost as the veteran buyer. And that can be used several different ways. Commonly, always, if you've not purchased a home yet, closing costs are not a set percentage or a set fee. It's the culmination of everything between title company, insurance, your appraisal, if your lender has any fees, if you paid anything for a certain interest rate, all that combined, that ends up being your closing costs, and a seller can assist you in that, and that's really awesome. I mean, getting the opportunity to have a zero down loan with a good interest rate because it's VA and really minimize your out-of-pocket cost. Seller concessions they're back, and it's awesome.
So it's a benefit for you as a buyer, but in lieu of, let's say, let's go back to that. We were talking about a $500,000 price point earlier. If closing costs are $10,000 or $12,000 on there, you can have the seller pay $10,000 or $12,000 towards your closing costs in lieu of reducing the purchase price. And there's pros and cons of each, and we're going to kind of go through that a little bit. But Ben, you hinted at, so explain the limits in a little bit greater detail. The seller can pay closing costs and prepaids, and above and beyond that, they can give you 4% concessions to use for an interest rate buy down and other things of that sort.
Yes. So the reason it's separated is because there are fee percentage limits. There's only so much that a buyer on any type of loan can pay, which is what, 3% total. And so in those categories, that's where seller concessions can help. So on a VA loan, that's 4%. So if you just play with that number, what can you do with their money? You know, well, you just hinted at, you know, there's the obvious stuff, which is whatever your cost is, but the current thing that you will see talked about a lot are buy downs, where you're actually buying down your interest rate, whether it's a permanent buy down or a temporary buy down. So in a temporary buy down, if I'm the buyer, if you're a buyer, you can't pay it. It has to come from a seller. So that is one of the biggest advantages right now to being in this sort of market where that is on the table. But if you have to have a good team with you. You got to have a great realtor, and you got to have a great lender who knows what these things are. So like Jason was talking about, his wife showing 8 houses, 4 of them had price reductions. Was that the best use of that? Were the price reductions because the value of the home was lower? If they weren't, if they were just to get it sold, there might have been a different avenue, like, hey, keep it the same price, but the seller can contribute some of their concessions towards you getting a lower rate, either permanently or temporarily.
Before we go too deep on that, let's make it super easy to follow for the folks at home. So you have a seller concession, a seller credit of some sort. Jason, why don't you walk us through the difference between a permanent rate buy down and what we're seeing has gained in popularity a lot in the last year, which are the temporary buy downs, a 2-1 buy down, a 1-0 buy down, occasionally a 3-2-1 buy down. What's the difference between those two?
Yeah, sure. So a lot of people are familiar with points, and what points are is when you're buying down the interest rate on a permanent basis. So you know, that's something that's very common and has always been in the industry and is a permanent thing. So when someone purchases discount points, you're essentially just lowering the interest rate on a 30-year fixed loan or a 25, you know, whatever the case may be, and it's a permanent buy down when you're buying discount points. But when you're doing a temporary buy down, the discount is actually greater in those first couple years because from the math that I've seen, so for example, if you're doing like a 2-1 buy down, well, what that means is on a temporary basis, that first year, the interest rate is going to go down 2 full percent. And then on that second year that you own the house, it's going to be down 1 full percent. So that's the 2-1 buy down. So you initially, at the start of the loan, you're going to get the biggest decrease in the mortgage payment. But long term, depending, and you kind of have to do the math with this. If you buy points, if you're going to stay in that house long term, savings actually could be greater, and you really have to do the math on that. Like, what is someone's use of the home going to be? Is it going to be 8 years, 7 years, whatever the case may be, and do the math like that. But you know, some folks are betting on the market kind of correcting interest rate wise, and then taking the temporary buy down with hopes of refinancing in the future, and then, you know, kind of playing that out. But that's generally how it works.
So the 2-1 buy down, just if you guys hear other numbers out there, a 1-0 instead of 2% for 1 year, 1% for 1 year, and then going to market rate, it's 1% lower for a year. It's cheaper. So if you get a smaller seller concession, you can use that. I see people talking about 3-2-1s. I don't know that I've ever seen one done, just so they get a little expensive. You can buy it down for 3% for a year, 2% for the second year, and 1%. But far and away, what Jason just talked about, that 2-1 buy down is the most common. Now, Jason and Ben, either one of you, when you're talking to a client, Sara negotiates a contract that comes across and there's 2 points in there as a seller concession. How are you going to talk to the clients about determining, is that permanent buy down better for you or the 2-1 buy down? Jason, you kind of hinted at it depends on your timeline and what you think is going to happen with interest rates. But are there anything else that goes into that calculation of determining which is going to be best for any individual buyer and borrower?
Well, it's comfort level to me because, temporary is exactly that. It's temporary. And if they're going to live in the house long term, and they have to be okay with the mortgage payment after the adjustments are done, right? Like after that, those first couple years, are you okay with the mortgage payment being what it's going to be at the current market rate, right? So they have to, it's just a comfort level to me. I have that discussion. Like I tell them what it's going to be year 1, year 2, year 3, and then, 28 years after that, right? And then are you okay with a permanent buy down, just knowing it's set in place and then being okay with that? To me, it's just personal preference.
Yeah. And we're in Vetivier right now, and a lot of people who will watch this are going to be, there's active duty, right? And that is definitely something where you're probably looking at a shorter term, being in that house. You may not know for sure. Who really knows when you get your orders, how long, for sure. So I always talk to people, even like you said, comfort level, but I'll just say money now, money later. Like, what do you need? What is your specific needs or goals or wants now? Because even if it's being given to you, it's still yours to use. So do you want, if it's money now that you want, then you're going to be okay with having a larger payment. So over time, the money's going away. But if you're wanting the money later, then you're going to want that money to use to buy it down, so that your payments over time are lower, and what I mean? So you're going to spend it one way or another, even if it's being given to you, you're still the one that's spending it. So do you need more money now, or do you want more money later? That's usually how I put it out to people. And it's a math equation. What does it look like now? What does it look like over time? Which one makes you comfortable? Which one do you need?
Another difference that kind of plays into that as well between the permanent and the temporary buy down. Permanent buy down is a sunk cost. In this example, we're talking about someone getting a 2-point seller credit. If I buy my rate down 0.5% with that 2 points, yes, as long as I have that loan, I get the benefit of a 0.5% lower rate. But as soon as I pay that to the lender, I never, ever, ever, ever get it back. If we use a little less than 2 points, we do a 2-1 buy down. And if the market goes in that direction and rates are lower in 8 or 9 months, and you're able to do a VA IRRRL and get a lower interest rate, that whatever is left in your account of that buy down account that's subsidizing your payment every month is going to come off of your payoff. So you'll owe less on the home. It's not a sunk cost if you get the opportunity to refinance. So I tell my clients, be very, very careful if you're going to get a seller concession for a permanent buy down, because there's a very good chance, not a guarantee, but a very good chance that we have a refinance opportunity in the next year or two. So the 2-1 buy down, while not permanent, it leaves the money there and available for you and not used up as a sunk cost at closing. So we've talked about a bunch of this now from the loan side. Sarah, when you have a client who's talking to a loan officer and they're considering a buy down, permanent, temporary, any type of seller concessions, how are you advising them either to allocate it, or how are you advising them in terms of asking the seller for the credit?
So every deal is different. Every property is different. All the buyers are different. As far as asking the seller for credits, I typically discuss that with my buyers up front, maybe even before we start looking, certainly before we make an offer. May talk to the lender to find out what the limits are that we can work with and what they plan on doing with it. However, I don't go into discussing their personal finances too much. I think that's not my wheelhouse, not my lane. I let them discuss that with the lender. As far as negotiating that offer, certainly we would want to go in and make an offer that's going to be good for the seller, but also serves the buyer in that they can ask for that concession, whether it's $4,000, $8,000, $10,000, and secure that for them. Secure that concession, and then now the lender and the buyer can discuss how they want to move forward with that. That's just not my piece. So I don't get into that with the buyers. I discuss it. I let them know that it's out there and it's available. But as far as what the right move for you is, discuss that with your lender.
And Josh,
And-
just one more thing. I mean, seller concessions, obviously they can pay all the closing costs as well. So if somebody's okay with the payment and just want to get in the house with as little money as possible, that's always a win for every buyer.
And let's quantify that a little bit also, in that $1,000 of loan right now costs plus or minus $6 every month. So when we're talking about, do I want $20,000 of concessions to pay for a buy down and all of my closing costs? What am I giving up to get that, versus saying I would like $20,000 lower price for my home? You're really, it's $120 higher on the monthly payment in terms of that additional $20,000 of purchase price. But if you use it for a buy down or on a permanent or a temporary basis, it's lowering the payment sum, and you're getting in with no money out of pocket, whether you have it and would prefer to keep it under your own control, or you don't have it at all. And the only way to get into the house is with the seller concession. So those are the discussions that we should be having. And, the best realtors that I work with are asking on the front end, like, where are the buyers at? What do they want or need in terms of concessions? We know the price range they're going to be looking in. Use that same example. They're going to be plus or minus $500,000. Closing costs are going to be within this range. And we've presented the buyer with all of those options: permanent buy down, temporary buy down, cover the closing costs, ask for it all, which again, it's going to vary. We talked about, if that buyer goes out and falls in love with the turnkey home that has 4 offers on it, they're not getting any of those things. If they go out and there's a home that's been on the market for 90 days and they're the only one in the world that likes it, they might be able to get all of those things. So that's sort of the dance that we're doing in the current market. Ben, you were going to say something before I jumped in there.
Yeah, I think we'd be doing a disservice if we didn't talk about, though there are people who are wanting, let's rephrase that. There are people who need to get into a home, and they don't feel like they're exactly ready. And it's not a money issue; it's a credit issue. There are situations where you need a home, right? But and maybe you're working a good plan to get your credit to a certain level, or numbers wise, or the actual contents of what makes up your credit report. But maybe there's a debt to income limit, and because of how everything's playing out for you, you're close, but you're just a little bit over. That is where a buy down can really help someone. And it's not necessarily a money equation in that situation as much to the buyer as much as it is they need into a home. That's the home that they want. It's the actual cost of it is reasonable, but they're not able to because of just these couple little things where the rate being lower would actually help them. Rather than, let's just call it 10 grand for fun. And let's say that 10,000 might take them 6, 8, 12 months using that money to do whatever needs done on their credit to get, to a certain level so that they can get the right rate, all this stuff. Or if they need in the home, people have families and kids and something. A lot of people now I've seen have taken care of their parents, so sometimes they need a bigger home to take care of their elderly parents. And that a buy down is really something in those situations that can help people to get what they need, which is the home, without having, to go through the long process that they might have with the same amount of money available to them.
Well, we talked about earlier that everyone seems to think that the only reason you would do a buy down is if you think there's a refinance opportunity coming in 6,
Right.
12, 24 months. And it's not necessarily true. You talked about the uniqueness of parents coming to live with them, a child moving back in, an adult child. You see divorce situations where one or both of the children move back in. But we have unique situations all the time with the Family Medical Leave Act now. If someone needs to buy a home, but we know one or both of those parents is going to be out of work for a period of time and have a decrease in income, it can be a nice bridge over those 2 years. If we have one or both of the borrowers, or the only borrower on there knows they're on a trajectory with work that maybe they're going to finish a degree and get a $10,000 a year raise or a promotion that they know is coming. There's any number of reasons that someone might choose to benefit from a lower payment for the next year or two, even if it's not permanent. It can be a bridge to a better situation further down the line, which kind of made me think of another thing here. pro and con versus permanent buy down and temporary buy down. Jason, how does a lender qualify you on a permanent buy down and on a temporary buy down? So we're talking about a lower payment for a period of time. Do we get to use that lower payment to qualify with both of them?
No. On the temporary buy down, you would on a traditional loan, you would qualify on the adjusted current market rate. So after the 2 and the 1 adjust, you would qualify on the market rate. Essentially, is how that would work for the temporary. But on the permanent buy down, it's just qualified on the rate that it's bought down to. So in that case, you would be qualifying on at whatever you can buy it down to, and then that would also help the qualification. So. Yeah.
So if we have a buyer who's pinned at the limit of their qualifications, that 2-1 buy down is not going to help them go any further. But
Right.
if they go out and they find a home that's $20,000 above their price range, but they can get a concession of some sort, either we can get a $20,000 price reduction to get them back to where they are, or a permanent buy down, since that is permanent, that's going to be the note rate for the life of the loan, you can qualify off of it. So like what I hope you guys are catching at home is there's a lot of nuances to this. And there are a lot of green loan officers out there that just know that it's harder to for a buyer to accept today's interest rate than it was the rates of 12 months ago. And they go, I got an easy button. We'll make it 2% lower than what it is. But a lot goes into that discussion of what your beliefs and expectations are of where the market is today and next year, what you think is going to happen with interest rates, with home values, all of that. So you need a loan officer on your side that understands that, and you need a realtor working with you that also understands it and how that comes into play. So Sarah, let's circle back to that conversation. Jason just mentioned he has a situation where they have a 6% seller concession. When you have a listing and that offer comes across asking for 6%, how are you advising your sellers? And what are the alternatives, or what can a seller be doing to make the home more attractive to begin with versus having to make these large concessions?
Well, I don't think concessions are a bad thing at all. And that is one thing that I will educate my clients about. So if a buyer comes along and needs concessions, one of the things I let my buyers know is if you have the cash to pay your closing costs, pay it. Otherwise, you're technically financing it over the life of the loan. If they do have the cash, great, pay your closing costs, and maybe you can use that concession to buy down the interest rate like we've been discussing. So that could be a win-win for that buyer. As far as sellers, as long as it does not interfere with their bottom line. So I know, Ben, you had mentioned earlier, there was a $50,000 scenario you were discussing where the seller may not get the 50,000, they might get 40. That wouldn't fly with me. I'm protecting my seller. I'm looking out for their money as if it were mine. And if you, Mr. Buyer, would like a seller concession, you're going to have to add it on to the purchase price. That's really my bottom line is we're happy to help you and help you get into a home. However, the seller's not going to pay for that. It's not coming out of their bottom line. So, and that's what I try to educate my sellers about. You're really not paying that money. It's not coming out of your pocket. Sometimes you have buyers that might only have a few $1,000s, but they have great credit and great job history. And this is a way that we can help people get into homes. It's a step into home ownership, even if they don't have a whole lot of money. So seller concessions truly does help them out. It helps them get into a home. Again, if they have the cash, pay your closing costs if you have that money. But if you don't, it's still a wonderful way to get your foot in the door of home ownership, as long as it doesn't intrude or interfere with the seller's bottom line.
So Sarah, you just opened up a can of worms that
No.
always comes up in the Vetted VA Facebook group when we're in there and we're reviewing and answering questions. There are people, borrowers, who may have done 3, 4, 5 VA loans over a lifetime, and they're going to insist that they have always financed their closing costs. You said in essence they are financing their closing costs, which is 100% true. But in reality, you cannot finance your closing costs. If the property will appraise for enough, you can increase the offer and the seller can pay them for you. You can increase your interest rate and the lender can pay them for you. So you can absolutely get into the property with no down and no closing costs out of your pocket, but they are getting paid and they're not getting financed into the loan other than to the extent that an appraisal will support it. You guys agree with that? Can we agree that that's pretty much the right answer, no matter how much our friends in the forums want to protest that they've 19 times in their life financed their closing costs?
You're
Yeah.
absolutely right.
And with that, Sarah, kind of staying on top of your seller net, one of my things in my notes here I wanted to make sure that we went through. A lot of times our borrowers, our buyers are saying, well, why would anyone do that? Why would the seller pay for my closing costs? And so why don't you walk us through what there's a fair market value for a home. There's a value that it will appraise for. And there's the concept of you as a realtor, when you are listing that property, your goal isn't necessarily to get a specific price for the home. It's to get the maximum net proceeds for your seller. How does that all come into play? Thinking in terms of what can the property appraise for, price versus concessions, and the bottom line of the maximum net for your seller.
That's a really good loaded question there, Josh.
We try.
Okay, so yes, you would do a market analysis before listing a home, and the goal is to get the highest possible price and put the most money in the seller's pocket as you possibly can. So you do your market analysis, you find out what a good ballpark range for what you expect the home to sell for, and you list it as such. So if I'm just going to pick numbers out of thin air, let's just say $300,000 home. And now we list the home for sale and an offer comes in, and you might have one buyer who might offer $295 with no closing costs needed, and it's just a straight $295 offer. Well, that's great. And then you might have another offer that comes in and it might be $295 but $10,000 in closing costs credit from the seller. Well, when you're looking at these two offers side by side, one of them will obviously net the seller $10,000 less. Is there a problem with the borrower? No, there isn't a problem with the borrower. They just need help with closing costs, which again isn't bad, except we're not doing it at the $295. If they need $10,000 in closing costs, my recommendation would be to go up to say $305. At that point, the seller it's not hurting their bottom line.
I love the example that you kind of walked through. So if you're watching at home and you're thinking, I'm in the market, and I think buyers get stuck on there's a value for a home. That's what the home is worth, and that's what it will appraise for. And we're talking about it's a shifting market. We went from sellers dictating everything and saying, you get nothing, I will repair nothing, I will pay nothing. And if you pay me more than my home is worth, you can get it. To now we're back to this dance of buyers and sellers where we're going to come to an agreement that works for everyone. A buyer who's sitting on $25,000 in the bank and doing a VA loan, and there's only $15,000 of closing costs, has a lot of options. But as you mentioned, some buyers don't have any money, so they don't have any options. So the seller is saying, well, what are my options? I have no buyers offering on my home. I've got 5 buyers offering on my home. So it's this dance of coming through and within the scope of what that property will appraise for, of getting a number that works for everyone. The seller wants to know what's going in my bank account once we close. The buyer wants to know what's my payment every month, how much money is coming out of my pocket at closing. Will I have enough? Do I have money left over? What are my reserves? So it's malleable. And one of the things that's important to remember is in the appraisal, when Sarah closes the home, let's say they close that home and they end up doing $305 with a $10,000 seller concession. That $10,000 seller concession gets listed in the multiple listing service. Why? Why does anyone care? It's primarily there for the appraisers that come afterwards to go, yes, that house sold for 305, but there were $10,000 of concessions. So that net sale was really 295. If an identical model match across the street sells for 300 with no concessions, well, it actually sold for more, and the market is able to see that. It doesn't work perfectly in the real world, but in theory, that's how it's supposed to work, so that buyers and sellers and lenders, everyone is protected and gets what they want. So I love the direction that we've gone with the conversation tonight. We're about 50 minutes into it. We like to keep these around an hour. Anything that you guys feel like we haven't covered that would be helpful for a buyer or a seller in the market, either with a VA loan or a conventional loan?
Well, the big news today was the official county loan limits came out. So anybody using bonus entitlement going forward with the VA loan is going to get that extra boost in their qualification amount going forward. So that's definitely good news for a lot of buyers who want to have two VA loans or multiple VA loans at the same time. So anybody who was pre-qualified before based on bonus eligibility, may want to get pre-approved again just to look at those figures now, because they're definitely going to be different.
We have an interloper to the show.
Sorry.
What is that number, Jason?
Oh God, I couldn't tell you. I was gonna look it up.
The new loan limit is 726,200.
Right.
And that's normal 726,200. I just want to do a little math for people, and then we were just 647,200.
Yep.
Yeah.
So that's 79,000. So theoretically, the disclaimer right now is you need to go through the process, but theoretically, that's about $316,000 for bonus entitlement. Different than where you were. So for people who didn't know for sure, a lot of lenders were already at least going with about a 715, I think 715 amount, but that's a whole house, really. For a lot of places, that's a whole house.
It's a big deal.
Do you guys know? Lenders on the conventional loans jumped the gun and been doing these for 3 or 4 months at their guesstimate number. But in terms of the bonus entitlement, do we have to get all the way into the new year? Is it after case number assignment before we can use those numbers? We're not going to be able to jump the gun here before the end of the year, or are we?
It's lender specific, and everybody I know can do it now. Jason can do it. I know I can do it. Because lenders, it's about when the lender sells that to Ginnie Mae, or who is it that goes to? Yeah. So like I know every loan officer I know has an outlet to do it so far.
Okay, so VA allows you to do it now, not based off case number, where FHA will make you wait till the first of the year for case number assignment to use the bigger loan amounts. Okay, awesome. That's super beneficial. It's funny, I have a client that I need to reach out to tomorrow that they're looking to buy. They were in San Diego. They just got moved. He's a recruiter, got moved to Sacramento, and they were going to have to make like a $50,000 down payment. Based off of today's number, it looks like more like a $25,000 down payment. So it can be a really big difference. And shameless plug for any of you who are having questions about bonus entitlement, go back through the feed here, either on the YouTube channel or in the Facebook group. We did an awesome episode on bonus entitlement and exactly how it works and how to calculate it, so that we don't have to stay here for another hour and have Ben and Jason walk through it for us tonight.
And Josh, the high balance loan limits are now over $1 million. So I know you're in California and has some higher loan limits, so that might help out a lot.
Yeah, no, we were absolutely bumping up against it in Orange and LA counties. So it will be helpful. Unfortunately, we have that 1% high balance loan level price adjustment that makes the pricing not look so pretty when you get to the high balance, but it's still an awesome tool, and it is nice to have that additional amount there available.
Have any of you looked? I haven't. I just thought of it to see if there's any new counties, any new high cost counties.
I didn't dig into it. One of my realtors, I was in his office and he pulled up the map today. The map looked really similar, but you would expect that. It's going to be at the margins of those high priced areas where the additional counties would get added. For us in Southern California, for veterans, San Diego County is a big one. And San Diego County gets high balance, but not to the full high balance. And if you've been
Right.
watching, their prices have gone nuts down there, and they're very close to parity with Orange County. So I thought this will be the year when they're getting the full high balance, and they're not. They're still under $1 million. I forget what the exact number was, but it was well under $1 million. So we do have these counties that are in between, in the middle. So, and this number does make,
like that.
yeah, and this number does make a little bit of a difference for us on the VA loans, right? So we have a high balance or jumbo where you have a slightly worse pricing. So now pushing that limit up, more people will get the standard balance pricing and get better rates with their VA loans, even if they're not looking at a bonus entitlement or any of that fun stuff.
Good stuff. I just wanted to say, if you're out there and you're using a VA loan, don't be discouraged. It's definitely a shifting market, and appraisals can be a little funny, but the VA loan is the only loan that offers you 2 opportunities to rebut that appraisal. So in my opinion, it's really the best product out there, even superior to conventional loans. So don't be discouraged, and have yourself a good realtor that can fight on your behalf for that VA loan, someone who knows the ins and outs. So if your realtor or loan officer are not well versed in VA loans, have them join the group for Vetted VA for Professionals Only, where we discuss different topics that they can come in and ask and get some support as well.
Absolutely. So really good stuff tonight, guys. I appreciate you giving an hour and sharing your knowledge and expertise. Anything else before we wrap it up that you guys wanted to close with? Sarah, you had that. Jason, Ben, anything else you wanted to cover?
Don't be afraid to buy in the market. There's a lot of trepidation from what I've seen anyway about what the housing market is going to look like a year from now, and what our interest rate's going to do. I'm encouraging people to buy right now because of the lack of competition that I've seen compared to where we were in the spring. So if anyone has the opportunity to get a house that they want and they're okay with the mortgage payment, then I encourage them to do so. Because I do have a feeling that, we will see an increase when interest rates drop in competition, and then people are going to be back in the same boat that we were in the spring, kicking themselves, saying, why didn't I buy in the winter of 2022 or early 2023 when I had the opportunity to get a house and get seller concessions? So, that's how I'm viewing the market right now. If you're in the market, please don't be hesitant about it. If you can find the right house at the right price and the right payment. That's what I would do.
I'm with you on that.
And I would encourage people to.
No, go ahead, Ben.
So many people, what is the saying? The best time to plant a tree is 20 years ago. The next best time is now. That's the same way with information. Like if you need information specific to you and your scenario, and maybe you're not even, like I'm a year out, either by situation, by circumstance, by whatever, it's okay to find out you're not wasting a realtor or loan officer's time by getting specific information to you now. Like we're here for that. Anybody that participates in the Vetted VA is more than willing to spend time, for you and with you so you have, I always say, I'm here to help you make the most informed decision you can make. That's what I'm here for.
Well, I know you guys get the same thing that I get. People nearly every business day, I'm talking to someone, they go, well, I'm not ready to buy, so I don't want to waste your time. It is never a waste of our time. Our job is to educate and inform, build relationships so that we have a lot of people that know, like, and trust us. And whether they buy or tell their uncle or friend or neighbor or coworker about us, that they have a source for information, honest, accurate guidance. It's what we do. None of my calls are a dead end, but probably 85, 90% of them don't lead directly to a loan. Sarah's probably don't lead directly to selling a house, but the more people that know and trust me and know that I know what I'm talking about, the better off we are. So it is never too early to talk to someone. You may be 5 years away from buying. If you have questions today about buying that's going to give you peace of mind, go ahead and ask. You can see from Ben, Jason, Sarah, myself, everyone, all of the moderators in the Vetted VA forum, that's what we do. Every day there's people there asking and getting their questions answered and giving you knowledge and expertise. So always reach out on that topic. You know, Jason had mentioned something about the potential for lower rates next year. None of us has a crystal ball, but there are very good and valid reasons to think that's a possibility, a distinct possibility. And every Wednesday, I think it's 9 a.m. Pacific, noon in the Vetted VA Forum, they do a live with Hammer Helmer and goes through interest rates and the markets and gives you guidance on that at a deeper level than what we can talk about here, where the market is now in terms of interest rates and where it's likely to go. What I like to tell everyone, we don't have a crystal ball, but it is sort of like counting cards. When you have the sources of knowledge and expertise and technical analysis, you know when the shoe is in your favor, and you know when you need to pick up your money and just go home. So if you're interested, check out Hammer every Wednesday, 9 a.m. Pacific, 12 Eastern, if I have my times correct. Every Tuesday at 5 p.m. Pacific, 6, 7, 8 Eastern, depending on where you're at. We get together for an hour and dissect a topic and pick these people's brains. So if you have questions, go to the forum. If you have specific questions, you want to talk to a lender in your area, go to the map. A realtor in your area, go to the map. We can get you connected with someone who can help. So again, Jason, Ben, Sarah, I appreciate you taking the time tonight. I appreciate those of you showing up and watching, whether you see this live or recorded, and we'll see you guys next week.
Take care, guys.
See you.